Buyers are doing a great job of holding the do-or-die level of support. However, I'm still not seeing a ton of broad-based strength, and this will need to change if we're looking for more upside. If it doesn't change, then my goodness, the weekly look above and fail starts to get extremely dangerous. So welcome to the Trade Brigade Midweek Market Update, where I'll show you exactly where and why that danger exists. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description, and stay tuned until the end of today's show. I've got 3 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off with a closer look at the SPY daily time frame chart. What do we see here from an overall trend perspective? The trend remains up with a great opportunity for a potential higher low right in this zone. We've been tracking 566 down to about 565.25, the previous all-time high. This is great, it's bullish, it's technically a higher low in the trend count, pulling back from the highest high in the trend count, the gap up to new all-time highs Thursday of last week. So that's bullish. The candle structure is also bullish. This, of course, is a daily hammer candle, where we look underneath the previous day's low and close back inside of the previous day's range. So we're holding on to this support. Buyers are responding to this key area on the chart, 566, 565.25. My issue is really just that the chart has been sideways stuck in a balance range, building out overhead supply. And this is why the weekly look above and fail starts to become so concerning. The more time that we go sideways here and positions are being built, think about it like this. Buyers had the opportunity to buy the pullback here once, twice, 3 times. If we reject 572 and find ourselves back down at 566 and 565.25, is there going to be a 4th opportunity to buy this same exact level? Or will there be a stop run underneath this level to get underneath the weekly breakout, produce a possible lower high, and then think about, overhead supply weighing on price in the downward direction, a lower high that's set here likely at least goes to the weekly line in the sand at 555.50. And if you just look left in history, it's not like this is a big shock. I mean, look at what happened over here. A failed break through the bottom end of the range, a lower high is set, and there's range expansion to the downside. I'm not calling for the market to go to zero, but I am concerned about the failure of the buyers to really produce acceleration into blue sky territories after 1, 2, 3, 4 failed attempts near that all-time high. Let's really break down what happened earlier on this week. Monday, we open in range underneath 572, giving the bears an edge. Jerome Powell finishes his speech, and the end of month, end of quarter markup happens. Great, we close outside of 572. This gives the buyers an opportunity now to say, okay, great, we've got 3 equal highs. That's the improper end of the auction. Let's see if we can get a blue sky territory breakout. On Tuesday morning, we open over 572, and basically in the blink of an eye, 90% of the day's range trades in about the first 5 minutes directly to the bottom end of the daily balance range. So if you ask yourself the question, are buyers really excited about trading to blue sky territories? The answer just continues to be absolutely not. And the fact that this can turn into overhead supply, come back down underneath, and give us something that looks like this is my concern and where I would be willing to take a downside trade. So where does this trade unfold? Again, we're not just willy-nilly shorting the market up here because we believe that, oh my goodness, markets are going to magically make it to 555.50. We're shorting the market when there's a breach underneath this key zone right here, leaving all of this as overhead supply. A lower high perhaps underneath is executable, and we're trading down into this outcome and trading down into this outcome if it presents itself. Once again, there's a very specific sequence that needs to take place here if we're shorting in an overall uptrend. We need to see this breakdown of the possible daily higher low zone, which leaves us with, if we're just inside the midpoint of this balance range, I really don't think that anybody has an overwhelming edge in the midpoint of a range. I would say that perhaps you can lean on the overwhelming trend remaining in the upward direction and saying, great, maybe over a hammer high probably gets you to the top of the range. I would really start to execute on long-sided ideas when and if we get consolidation over 572, expecting that once again, this is the improper end of the auction. An all-time high should not be set like this. I would expect a breach if we could test 574.40 on consolidation holds over 572. I do just quickly want to go to the weekly time frame chart in case someone's watching and maybe, you didn't check in on the Saturday video. That's fine. The reason that the weekly look above and fail is such a concern, not only the overhead supply we were just talking about, but if we get a weekly bar that closes underneath this zone, 1, 2, break, if we close underneath, which is definitely doable, like this is not a stretch of the imagination that the weekly bar might look something like this, that starts to open up the opportunity for a little bit further downside continuation, a weekly lower high underneath. Now we're talking about a major trend reversal. Right? So that's the weekly look above and fail that becomes dangerous, a really lackluster breakout into all-time highs, weekly trend reversal. And, again, this is not going to happen over 2 trading sessions. You're probably talking about 2 or 3 weeks into the future for a full weekly trend reversal, but the stage is going to be set on the first weekly close underneath this level. And again, I've already voiced my concerns on the daily as to how that can possibly happen if this all turns into overhead supply with a close and a lower high underneath 566, 565.25. We're noting the weakness, the lack of excitement and euphoria near these blue sky breakouts. Let's take it down to the hourly just to really walk through that Monday-Tuesday interaction. So Monday, we open underneath 572. Sellers do exactly what they should have done on a daily look above and fail. If this is the range, this is your look above, this is your failure. This lower high underneath 572 cements that the sellers are more so in control. Jerome Powell's catalyst, and then of course, boom, end of quarter, end of month markup. There you go. You get this close back over 572. This is an absolute gift to the buyers on Tuesday with the open over the base of the spike. Now ask yourself the question, in a picture perfect world, what would buyers have done? This should have acted now as support. You should have seen some sort of double bottom, some sort of, hourly hammer candle that prints around here, an inverted head and shoulders that uses this as support, and then some sort of breach up and through these equal highs for a blue sky breakout. It absolutely did not take place in the first 5 minutes of that Tuesday morning open. We're basically straight down to the bottom end of the range. And once again, I will give credit where credit is due. Yes, buyers are stepping up. They're defending this key area of support. But does that mean that we're just all aboard the long train looking for a massive breakout? Probably not. If I go ahead and just sort of give you the explicit pathing for the remainder of this week, it probably looks something like this. In here, absolutely choppy. Might there be a scalp to get to the top end of the range from point A to point B? Be my guest if you're quick draw McGraw, but the best long trade probably looks like this, and then a breakout into blue sky territories over 574.40 on the strength of market internals, which we'll get to in just a second. They look incredibly lackluster, right? So to the downside, that means that you have an equal and opposite threat here. If there's any sort of breach of this, great, maybe you make it back down to the bottom end of the range. I would not be a dip buyer on the fourth opportunity once, twice on Tuesday, 3 times on the open today. Fourth time, probably not the charm, especially after highs, lower highs coming into an equal low. Probably don't want to be a buyer there. And instead, I would more so say this starts to open the door for the downside we were just talking about on the daily time frame chart. So really, it's balance rules in play, but when you make observations, I should say, about these little nuances of who's in control of price action, I would tend to think that there's a slight, ever so slight leaning here for the bears. Now, again, you want to play devil's advocate? Yes. We breached underneath the previous day's low. There was no follow through to the downside, but we weren't even able to make an hourly equal high or higher high. So I'm still in the camp of leaning a little bit, just a hair, more to the bear side than the bull side with the lack of euphoria up here. If you want additional information, you can take a look at the intraday anchored VWAPs and notice that from the FOMC and the gap up all-time high from over here, right, you're actually underneath both of those anchored VWAPs. Yes, this one's acting as support. Absolutely. We'll give credit where credit is due. Off of the bottom reversal, absolutely. Confluence of support with that daily line in the sand, 566, 565.25. But what does this all go back to? It's the comment I made on the daily time frame chart. There's a very specific criteria if the short trade is going to unfold. Consolidation here is bearish, and we execute on this idea with a path that looks something like this. Let's get into some further supporting evidence. This is the market internals dashboard. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. What do we see for the week in terms of volume flows? Absolutely negligible. There's nothing substantial here. Remember that substantial reads 300 million, negative 300 million. So you could read it both ways. It's not substantial to the upside, but it's also not substantial to the downside. So let's try to keep an even keel here. If we're thinking about the advanced decline line, it's technically more so under the zero line than it is above, but we're not in trend lower zone. So this probably leans a little bit more bearish, but nothing overwhelming. If we look at the index score, which measures from the opening prints, Tuesday, of course, is a bloodbath. But let's take a look at Monday and even today's Wednesday session, where we did see a decent move in the upward direction off of the lows. Intraday, that was fine. Was there really an outstanding amount of strength with an index score around 20, 25? Remember, this reads out of 30 different data points. The answer is no. The same thing on the reversal into the close of Monday. We never got up here over 15, 20, nothing. So I'd probably lean neutral to bearish on the index score as well. What about the cumulative tick? Again, this has no regard to the previous day's close. It's literally tick by tick data. It's extremely lackluster. On the Tuesday breakdown, at least it's not getting negative, so that the sellers don't really have strength and momentum to carry this underneath the bottom of that daily range. But even on the pullback long this morning off of this low, the bottom end of the range, did the cumulative tick close positive? The answer is no. It closes right at the zero line, basically. Negative, what was it? Negative 487. I mean, hardly worth reading into, but you're just not seeing strength even on the reversal off of the lows here at the exchange level, which once again, to me, leads more towards, be cautious. And if we break that low of the daily balance, probably looking for downside. What do we see here out of the market profile? If you're not familiar with the profile, check out the video tutorial in the top right-hand corner. This is where we actually have slightly bullish improvements, right? And the reason I say that is because you can clearly see the note of Tuesday's value and point of control, the yellow highlight, versus today's. Technically value's inside, but there's minor progress in the upward direction out of the point of control. Now, is this enough of a reason for me to say something like, oh my goodness, it's time to long this, we have to break to blue sky territories, full portfolio, full margin long, this thing's got to go make new highs? Absolutely not, but it is a step in the right direction from at least preventing value from developing lower in this profile, which then in theory could add to the downside pressure. The only bearish thing you might say, and this is a bit of a stretch, I don't want to make it, we're not trying to find bearish data points that don't really exist, but if you put yourself in the shoes of a long trader who did not buy the low of day during today's reversal off the bottom, but rather executed into the afternoon, if these are new money longs, I'm just going to go NL for new longs, and we start to get underneath value, if we start testing this area, the bottom of the daily balance, right, what would that imply? Well, these new longs are dead underwater. So that's something to just carry forward. Again, I'm not trying to fish overly aggressively for bearish data points, but if the positions are being held from here and we're undervalued tomorrow, obviously, you can put two and two together. Those positions are not profitable. We do have a poor high on today's session, so let's keep an even keel. We do have that poor high, which means in theory, if we test that, we should look for a repair of the poor high by moving through it to fix that structure, right? This is really a lack of material excess, the improper end of the auction. We would look for higher, and there are A period single prints to potentially recover in the upward direction, and this would really just align with, right? You could talk about something like, 57.70 is really the level that we've been using in the ES futures. If we get over that, you can maybe get this thin structure retracement. If we go back over to the S&P cash, that would be the equivalent of getting over 570 to trade into 572. Recall that just a moment ago, I had said that this is possibly a scalp from point A to B. It's really got to be a quick draw McGraw intraday style trade. You don't want to overstay your welcome on that. It's really just a thin structure retracement from the market profile single prints. With that, we will jump on over to the nasty NASDAQ and see what's going on in QQQ land. Daily time frame chart kicks us off. Another reason to be somewhat concerned, right? As the S&P is failing near all-time highs, the NASDAQ is not holding up over its previous pivot high here. In a picture-perfect world, this pullback from the gap up on Thursday of last week should have yielded a higher low over that zone, which is roughly around 483. Now again, we'll always give credit where credit is due. This is looking like a decent inside bar from today's session. It is holding over what I would consider the absolute line in the sand on the daily time frame chart, because what this represents is the inverted head and shoulders neckline. This is a do or die level right here. So the NASDAQ's also holding, but you're already underneath a pretty key inflection point that does not really support the continuation of the S&P 500. So walking forward here out of the NASDAQ, I would really lean on this 477. If we're above that, then great. There's maybe not an actionable short. If we're below, absolutely looking for shorts that probably do this. Remember, what goes straight down and goes straight up can probably come straight down once again. That would be underneath 470.75, trades into 460. Once again, this is not a forecast that this has to happen into the end of the week, but that's the threat that's potentially setting up with the lack of acceptance over this previous swing high. And the support here needs to hold at 477. To be bullish here, of course, what we would want to see is the exact opposite. You want to get back over this weekly pivot high. You want to see price acceptance up here at 486. So as long as we're underneath that, I would say it's neutral at best. Bullish starts to step in here. Bearish absolutely on the failure to continue higher if we're under 477 based on the daily analysis. What do we see on the hourly time frame chart? Very similar to the S&P 500, where on Tuesday, you open back over a key level after Monday's end of day rally here. There is no support at 486. And right now, I mean, for the lack of a better pattern, it's absolutely bear flag consolidation here with the possibility of hourly trend continuation, possible lower high here after lows, and lower lows. How is this not an hourly downtrend? It absolutely is. So if we're below 483, if we're getting consolidation down here, this is primarily what I'm looking for. If we're over 483, Quick Draw McGraw can probably play for the 3-point range there. That's absolutely a scalp that's available. But the better bullish outcomes, I'll flip to the green crayon, start to step in when the market does something like this and can prove it to us with the strength and help of market internals that we're getting acceptance over 486. We just do not have that in the market currently. Let's jump on in here with the anchored VWAPs intraday. Just like the S&P, underneath this, or actually these two, FOMC and the gap up high from back here. I'm curious to see, what is this date here? This is 9:30 on 9/26. Let's edit this. Let's go 26, a little bit of real time analysis for you. Let's jump this to 9:30 and let's see what that brings. All right, so we're underneath that, of course, as well. Not a shocker. I just wanted to see how close, if there's confluence at this level of 483, the most recent pivot high. Great. As long as we're below these anchored VWAPs, once again, probably leaning on at best neutral, probably thinking about bearish outcomes here for that breakdown we were just talking about. So that's the interpretation of the nasty NASDAQ price. Let's take a look at the NASDAQ's internals here and see what else we can learn. So different to the ES, the S&P 500, the NYSE exchange, the NASDAQ actually did see more substantial volume outflows on the Tuesday session. And I think the best illustration is just the cumulative volume on the week. You can clearly see that net flows are out for the Monday, Tuesday, Wednesday session. If we think about the advanced decline line, it's clearly in trend lower zone on Tuesday, and today it's just tangled up near zero. That's another bearish takeaway. Monday, clean cumulative build. Tuesday, clean cumulative build. Today, a little bit flatter. But once again, as we're sort of trying to navigate a hold of this level on Monday, at the exchange level, to see this amount of bearish tick data probably doesn't give you a ton of confidence on the types of participants who are entering this market looking for this pullback to continue in the upward direction. So massive improvement needs to be made here if we're thinking about reversals and bullish recaptures of that key level. Once again, 486 here. Let's finish up the NASDAQ with a look at the market profile, NQ futures. What do we see? Similar rinse and repeat, just like the S&P 500. Value is overlapping to up. Point of control migrates in the upward direction. This is a bullish data point. If you get through this structure here, there's absolutely an A period single print retracement back up towards this high. That's the exact trade we were just talking about on the chart here, where we go from 483 to 486. So not a shocker. Market profile does align. Let's take a look over at the IWM. Let's see what's going on with small caps here, which remain divergent as well. Why does this remain divergent? Simply because we have broken down today underneath a double top neckline. It is not really holding up over key areas of support. As the broad market, the S&P and NASDAQ, were more so going sideways, the IWM was clearly trending lower. Now, we're inside of this overhead price block, so I'm not trying to argue that it's the end of the world as long as we're over 215. However, look at the upper wick from today's session. Where did we reject? It's the neckline of the daily double top. So the fact that we're seeing sellers already step up on the back test of 218.35, the fact that we closed there underneath that level, that to me, like, this is just bearish consolidation. If we just take this immediately down to the hourly time frame chart, this is absolutely bear pennant that's setting up here with acceptance from the sellers underneath that 218.35. So what does that spell into the end of the week for the S&P? As long as we're underneath, I mean, this gap close is a potential idea, 215 is a potential idea, and of course that just spells downward pressure in the S&P anyways. So you're not even seeing stagnation in IWM. There was no very strong end-of-day rally on Jerome Powell's commentary. There was no window dressing here out of this name. There was nothing to get you over 221.75. There was no open over on Tuesday. Nothing. This was weaker relative to the broad market S&P and NASDAQ earlier in the week. So this continues to offer a little bit more of that bearish pressure as well when we're thinking about all of these data points. Let's check in on the intraday anchored VWAPs. You're underneath 3 of the 4 anchored VWAPs, unlike what we saw in the other indices, where you're only underneath 2. You're still supporting off of this. This is now acting as resistance. Sure, maybe this is acting as support, but this is bear flag, right? So to me, it's not really adding up that even though the S&P is holding key support, I'm still not seeing all the signs of confidence that say, hey, this is a great pullback to buy. Everybody's euphoric about a new all-time high breakout. Again, I want to be very clear that there's no reason to short the S&P if we're over that 566. Like, please, nobody misinterpret my words here. It's just inside that balance range. Honestly, I think the market can continue to chop and forbid that it breaks down. Now we have a ton of overhead supply. That's really the concern I'm sort of vocalizing here out of the market analysis. Let's quickly check in on the Russell internals. Strong volume outflows on Tuesday, not a shocker there, near the trend lower zone on the advanced decline line, and some pretty flat, slightly more bearish builds out of the cumulative tick. If we check in on the market profile, we will see that we've got value that's still somewhat overlapping to up technically, but the point of control, interestingly enough, migrated lower actually from here to here, which does make more sense. We just noted that the structure was bearish holding underneath that 218, 50 level. 218.35, interesting, not a round number in the sense of quarters, but 218.35, the nickel will do. We're holding underneath. So to see that point of control migrate lower, even though value is slightly overlapping to up, kind of makes sense. And once again, sort of aligns more so with the bearish narrative here out of small caps, not really supporting a huge recovery effort yet in the S&P 500. To really change my tone to be bullish, let's bring this back to the bright side, shall we? If we're going to be bullish in the S&P 500, I likely at least want the IWM in here to start to signal inverted head and shoulders. And then the breakout in the S&P 500, if we're really looking for that follow through, would be over the neckline to the equal high as the S&P is breaking out through the 4 equal highs, attempting a blue sky breakout, right? That's the optimism here. If we want to see improvement, it's over 218.35, breaking out over 221.75. Let's move along into our S&P sectors. It's throwing me off here now that we came back to the IWM daily chart. Let's jump into the S&P sectors. Let's get granular. Let's really start to break this thing down and see what other supporting evidence we have. Leading the pack is energy. This, of course, is due to the geopolitical tensions happening over in the Middle East. So that's kind of a sidebar point. We'll see if that continues to be the case. Once things, loosely, air quotes here, I'm never going to claim to be a geopolitical expert, but if and when things settle down, I'd be interested to see whether or not energy sustains higher prices or whether or not those fears of global slowdown, recession word, continues to put downward pressure on energy companies here. So up 4.24%, but mainly geopolitical catalyst there. Utilities are up 1.1%, industrials up 0.32%. Everything else is really lackluster on the week, which I think reflects fine based on the daily balance here out of the S&P. At the bottom end of the barrel, it's consumer staples down 1.56%, consumer discretionary 1.21%, and materials down 1.01%. If you look at the heavyweight sectors, and we're really, leaning on the XLK. Where is the XLK? Did this get? Oh, there it is. Down 1%. That's a little bit more bearish. The semiconductors down 75 basis points, a little bit more bearish. But look at something like financials up 20 basis points. Healthcare, this third heaviest weight sector, 6 basis points. It makes sense that the market's really struggling to do anything meaningful when the heaviest weight sectors are sort of pushing and pulling back and forth. Let's take a look at the individual structural charts, see what's going on. So energy, maybe inverted head and shoulders if we can sustain price sort of over this 90.25. But once again, my take here is that this is geopolitical. And if things continue to just slow down and grind to the downside, I wouldn't be shocked to see acceptance back underneath 90.25. What would be most interesting to me for, again, a stronger recessionary theme to emerge is something that's like immediately back down towards these lows. 85 potentially breaking for a new swing low, not holding that right shoulder. That would be a big cause for concern. As of right now, because it's a lighter weight sector, I'm not going to read into it too much for the S&P. Let's take a look at utilities continuing to grind in the upward direction. New all-time highs day after day after day. Most bond-like sector, it's continued to grind. This is technically a little bit more of a risk-off indication, seeing this at the top end of the list as the S&P is trying to hold key support. Industrials trying to grind towards the all-time high, but more so balanced than anything else. The chart doesn't look horrible. I think one of the things we want to lean on here is one of the comments I made, which was that sure, you could get this daily pullback, but I'm not expecting the S&P to go to zero. And the main reason for that is that industrials look fine. Like this is 8% of the S&P. You could easily get a weekly higher low here. Real estate looks fine, right? It's a lightweight sector, but you could certainly get a higher low here over 4360. There's no real big bearish trend change here on these sectors. Communications, same thing. New all-time high breakout, plenty possible that you get a new, higher low pullback over the prior all-time high, closer to 88. So the pullback in the S&P aligns with sort of these pullbacks unfolding in the sector, but not dramatic shifts in structure where we're expecting like Armageddon 2008 style crash, right? I think everybody misinterprets the headline, the title of the video, the thumbnail of the video. Oh my God, this guy is such a bear. Why is he always saying the market's going to crash? I'm not saying the market's going to crash. I'm just very cautious of new longs in the S&P near this all-time high. Financials, what do we see over here? Higher low possibility coming from an equal high. Looks like a great opportunity for an ascending triangle to build out. Hammers here back to back to back. If we get up towards this equal high, in theory, we should look for an equal high breakout, and that, of course, would be bullish for the S&P. Let's take a look at the healthcare sector remaining underneath its neckline. But recall, although this is the third heaviest weight sector, it's also D for defensive. So if this just remains inside of this box, that's really fine. We don't want massive outperformance, but it certainly would help if it's over 154. If it's just in this range, it's not the worst thing in the world. I would be more concerned on a lower high breakdown beneath 150, 150. Next up, consumer staples, bit of a pullback underneath the head and shoulders neckline. Remember, left, head, right. We talked about this on Saturday. There you go. You're through. I think that a daily higher low, maybe weekly higher low at this point. This was a pullback from the highest high into an equal low, so this is probably a lower low. This is a daily trend reversal underway already, but a weekly higher low could be found at the daily 50, which is at 81.36, so potentially watching out for that here out of XLP. This is also D for defensive, so to see it breaking down as the market's trying to reconcile that consolidation, not really the end of the world. Discretionary, though, on the other hand, is absolutely more of a risk-on and heavyweight sector. Once again, leaning on something similar commentary-wise, like what we talked about on communications, real estate, industrials. What's the opportunity? Continue the pullback, find a higher low, and technically the structure is fine. Your key hold is 193.50. I like the fact that just like the S&P, it breached the previous day's low and then closed back inside of range. So the sellers are not really accelerating price in the downward direction here to get the full retest. So either way, if this just consolidates or if it does pull back and holds in here, I would still be bullish on discretionary. Materials are the lightest weight sector, just like communications almost, or industrials. This is fine. If it makes a new swing low, if it gets acceptance back underneath 93.60, if it does something that looks like this, I'll be concerned, but not yet. XLK, the technology sector, deeper pullback, absolutely, especially on that Tuesday session, but notice opportunity, and we're still over that main level we talked about from Saturday, right? You can see that these are dashed because I wasn't as, worried about them, but a higher low must be found over this level at 218. If we're underneath that, I think you really fall more so into range compression. You have too much of a failed opportunity again for a weekly lower high. If you're not supporting this 218, I would say that's a larger red flag for the broad market as a whole. So watching this very closely into the end of the week to see how it aligns with any movement in the S&P under or staying above that 566. TLT, just to take a look at bonds real quick, have pulled back and continued to move in the downward direction. So rates moving higher, of course, with sort of some of the expectations from Powell being a little bit more hawkish and maybe pushing away from that 50 basis point cut in the next November meeting and maybe just 225s to end out the year. We'll talk more fundamentals in just a moment. Semiconductors, what do we see here? Possible for a higher low, right? Just like the XLK, basically. This is your do or die level at 237. We had talked about that for a number of weeks in here as there's just a relentless battle around that zone. So want to see it and really need to see it hold as support if we're going to maintain more of this bullish stance. If this is going to morph from a double bottom and not break the neckline on the first go, it's got to sort of morph into an ascending triangle that holds its support point and then possibly breaks over the flat top at some point. Next up, let's move into our ratio grid to see from a relative perspective, how are the charts performing? How are the sectors performing? Still a red flag, not getting any outperformance from the XLK. Really tangled up sideways here. This, of course, high, lower high. You have lows. Maybe this is a higher low in the form, in formation, I should say, but we're not there yet. So still concerned about this, especially with the still downward sloping 50 SMA. XLV underneath the 50 SMA strikes me as being fine. Reasonable pullback out of discretionary. XLF under the 50 SMA. It's got to recapture this quite promptly. And honestly, I'd like to see a new swing high over this to prevent some sort of like, instead of just a mild pullback into the 50, if this gets a lower high and continues, that's easily the beginning stages of a trend reversal out of the ratio, which starts to suggest more of a risk-off posture here. Speaking of risk-off, utilities continue to break out new swing highs out of the utilities ratio. It's very difficult to look at this entire dashboard and say, hey, everything's fine and dandy. Blue sky breakout should be right here, right around the corner. The sector posture is correct. Everybody's euphoric. It's not the case. You're not seeing it out of these ratios. Even if you take a look at the specialized ratios, right? Let's take a look here. You'll notice that you've just sort of made an equal high and you've pulled back. You need to see that higher high come in here if we're going to be more bullish on this ratio. If you look at utilities relative to tech, it's just getting absolutely flattened. Tech is getting outperformed by a long shot here. If this breaks the bottom of the triangle, what does that suggest about the broad market? Probably not an all-time high that you want to participate in. Wouldn't really trust it. The only sort of comparison that's been a little bit more bullish is the apples to apples discretionary versus consumer staples, and that's getting a little bit of a flat line here after a very impressive move, but that's 1 out of the 4 in this top quadrant grid. If we take a look at semiconductors versus the healthcare sector, kind of a look above and fail, already back down under the range. It's critical that this holds a higher low and gets continuation for an equal high, if not swing high, new swing high in the very near term future. Otherwise, once again, all of these charts suggest more of a mixed bag, leaning towards even risk off and not being full-blown risk on. This is the only constructive look down here. I will just point out that the yen is continuing to grind in the upward direction. There's been a huge, move, obviously, in, let's go to the Japanese Nikkei. It's N225. There we go. Huge move to the upside on the China stimulus. China markets are obviously continuing to move in the upward direction as well. You could use proxies like Alibaba, Futu, Bilibili, you name it, and those charts are just gapping up like crazy. So foreign markets there don't really strike me as a big deal. I wonder if we take a look at EEM as an emerging markets ETF. Yeah, let's just use this as a proxy for it right now. Huge move to the upside, and this is a daily chart. I even want to go out to a weekly, right? Look at this base on the weekly. Look at this. Breaking to the upside. We tweeted about this not too long ago. EEM getting this continuation on the China stimulus. So all set there. I wouldn't really think about the yen carry trade unwinding being a huge impact to our U.S. markets these days. Let's jump on over to the dollar and see what's going on with this. Speaking of currencies, a little bit of a grind in the upward direction, which makes sense to see equities coming down a little bit. Let's check in on gold and see what's going on with gold. There it is, the yellow metal. Certainly getting some sideways consolidation after the technical break. Remember that I've been a proponent here that it is nothing more than a technical break. It's not a full-blown flight to safety when you look at this through the lens of a ratio, right? And just one more time to do it live here on air. Let's just come in here. Let's maximize one of these guys, and we'll come in and we'll go gold, GLD, relative to the S&P. Good, okay. And what you'll notice here, let's grab even more time. Let's go to a yearly, right? You have not really made a huge new swing high breakout as gold itself, the actual chart of gold, has made that big move higher. So I don't see it as a full-blown flight to safety. I see it more as a technical breakout more than anything else. Let's move along to interest rates here. Stable and sideways near these areas, which to me is a good thing. Interest rate stability is going to mean a lack of volatility out of the markets or just massive uncertainty. I would expect this to change slightly on the release of the full labor report coming out on Friday at 8:30. So as we start to get a little bit more fundamental, let's check in on the inverted ZT, a little bit stable down here, even getting some lift. This lift really correlates with the Fed tracker tool, starting to suggest that it's actually unlikely the 50 basis point cut comes in for the month of November. Here you go, November 7th. Right now, only 35.7% odds of the 50 basis point cut, leaning much heavily more towards the 25, which in my opinion, you guys know I've been very vocal about this. I'm not trying to hide anything. This is my personal opinion, and the charts somewhat agree with this, but I think the risk of inflation re-inflating, literally wave 2, is higher than the labor market right now. And we can get into this by just looking at some of the data we got this week. So Jerome Powell on Monday spoke explicitly about not wanting to see further cooling in the labor market. Well, what did we see with JOLTS on Tuesday? Huge beat. I mean, we got 8.04 million versus the 7.64 million expectation. If we take a look at more of a detailed chart here, it's this uptick that you're seeing all the way off to the right-hand side of your screen. And if you look at the job openings per unemployed person, we're at 1.1 ratio. So still, it's a competitive and tight labor market, but it's not something where, oh my goodness, there's this huge excess of jobs or there's not enough jobs at all for anybody, right? This is sort of the sweet spot, right around that 1.1, just slightly higher than one job opening per unemployed person. So JOLTS comes in, and again, that seems to me like a reason not to be overly aggressive with another 50 basis point rate cut. If we take a look at what happened today with the ADP non-farms, 143,000 versus the 124,000 expectation. And also, this is critical, this got revised up, the previous reading from 99,000 to 103,000. And you could talk about how the data is cooked. You could talk about how unreliable it is. You could talk about whatever you want to talk about. But what should we do? Should we make up numbers? Oh, TB Matt says, I think that there were, 350,000 jobs created this month. Is that better than using some sort of data survey? Probably not. So using the data we have in hand, let's just forget about the actual numbers that are happening here. What's the directional vector? Which way are we moving? Are we moving in the right direction for, letting that labor market remain resilient, or is it starting to weaken? Certainly moving in the right direction based on the ADP non-farms. If we take a look at the breakdown over here, what you'll notice is that the ADP, which is the bars underneath, the purple line, is the government non-farm that comes out on Friday. The ADP has historically been pretty bad at predicting where the government number is going to be, so this is one data point. It's why I refer to it as the ADP non-farm preview prior to the actual government release on Friday. So we did see an uptick. There is a little bit of a recovery here. The next big question becomes, is that going to translate to, again, not numerically, not the exact numbers magnitude-wise, but directionally as a vector? Are we moving in the right direction with the labor market? And as of right now, I don't see a reason for it not to. And my thinking behind that is really more so along the lines of the initial jobless claims and continuing jobless claims that have been really stable over the last, 2 or 3 weeks. We have not seen huge upticks there. So really on Friday, I'm not forecasting a huge miss here on the unemployment rate. I think that this is going to be fairly accurate. I'm not really concerned with a wage price spiral. I think it's more about services inflation and housing. So that's not really an issue for me. And this also seems to be like it's going to come in line based on the directional move that we saw out of the ADP today. So I don't know how much volatility we're going to see here, but all of the data that I can see, that's public, and, I'm not claiming to be a rocket scientist for putting this together. I'm sure other people hold similar views. I don't think there's a need for another 50 basis point cut in the month of November. I think a 25 and another 25 to end out the year, something in here, gives us just fine. Like that would be spot on to the SEP that Jerome Powell and FOMC board members issued in the September meeting. So that's my personal take on what we have from the fundamental side of things. As we take a look at the earnings calendar, nothing really worth paying attention to here. Levi's after the close today. Haven't even looked at the chart. Doesn't really move the needle for the S&P. So let's get back on over to the platform. Let's finish up our analysis tonight and see what's going on here with the TLT ratio. The reason I bring it up, we know it's not always reliable, but because it's so close to this breakdown level, I do want to at least mention it. If we're underneath 0.17, that would be bullish pressure for the S&P, or at least it would support the idea that there's more of a risk appetite for equities. Let's jump on over to bonds relative to themselves. The longer end of the curve is starting to come into an equal high versus the shorter end, still in an aggressive downtrend. Really just makes sense based on the way that rates have been cut in September, and we're sort of navigating the 25 versus 50 basis points for November. Let's jump on into the credit spreads. Continuing to see downticks and just downtrends in general over here. Once again, risk appetite still remains strong for equities, which I think is more supportive of the comment that we had made that, okay, a daily pullback is fine, but we're not arguing that the market's going to zero. I mean, credit spreads would not suggest a credit event is imminent. Oh my goodness, duck and cover. Nope, not there. High yield junk bonds are signaling a little bit more of that pullback thesis here. Notice that this was more so correct when it was making a higher high here, leading the market to break out. However, it most recently produced an equal high and is now sitting on a lower low. And the market's, just to have that bullish thesis without really seeing the follow through here in HYG. We've also been using the LQD, which is corporate grade bonds, more of a sustained downtrend over here. This to me aligns more with the pullback narrative we've been sort of pushing forward in the S&P anyways. Let's jump on into into Bitcoin breaking down a little bit, and this is actually going to tie into one of our trade ideas towards the end of the video, underneath this 61,000, you're just back underneath this balance range from back here, probably thinking about a sustained pullback over time, more of a drift here as there's uncertainty around risk assets. Let's move into our breadth. Breadth is contracting over the week so far. We're seeing a downtick out of the moving average chart as well as new highs versus lows. Once again, not an Armageddon crash. We're going to zero. We're still over the zero line on new highs versus lows. As long as we're above, I think a pullback's reasonable, but once again, not calling for a crash. I want to be very clear about that. RSP looks fine over its previous swing high back here. I would say that this is actually a small bullish divergence, just the fact that it's not making as cleanly an equal low to the bottom end of this range. So maybe that's a small feather in the cap for the buyers. The QQQE and Dow Jones Industrial are basically saying the same exact thing. So moving along to the VIX, a little bit of an uptick here as we await the labor report on Friday. I think that's reasonable. Looking at what's happening in the VVIX, you are getting an acceleration over 103. I was a little more optimistic for a potential pullback after Monday, seeing this thing kind of settle down a little bit. I would have preferred to see that if I was going to be more optimistic about a blue sky breakout. So the fact that volatility is actually up as we're headed into the report, it leads me to believe that some people are still uncertain and not willing to really execute up here near the highs. One of the market mechanics I do think you want to pay attention to is that once that report comes out on Friday morning at 8:30, you're going to see a crush of volatility, right? So we'll see how Thursday's bar closes out of the VIX one day. If it's up here tomorrow and then on Friday we're opening down here after the report is released, you're probably going to see upside in the market just because of the way that volatility sort of contracting leads to equities being bought up, right? So that's something to consider as a mechanic, but once again, doesn't really speak to whether or not that structure in the S&P is going to break. It's more of just a trade idea or something to understand, right? We're still in a backwardation up here, which I do find fairly impressive, and this is the real deal. If we take a look at the VX futures over here, the active contracts currently trading, whoa, let's see this. We've got $20.08 on the active contract. The next one out for November is trading at 1909. So the market's currently pricing in less risk in the future there. And that could have something to do, of course, with the election. Keep that in mind, just as a potential unknown for the market, just a reason to throw a little bit of a temper tantrum. So with that, we will jump on into our core list of companies, do a quick run through, and then I've got 3 additional trade ideas for you. Apple looks decent here. And the reason I say that is because it technically swept the lows. It made a new 2-day low and then closed back inside the range. So it looks good, holding on to like what you could consider just this shelf. Let's go way back. Let's do something that looks like this. Previous support, resistance, support in here. Sellers failing to accelerate. My only issue with it is just that it's in the midpoint of a very choppy range. I'd be more, willing to consider Apple longs on something that looks like this, almost very similar to the S&P 500 anyway. So that's 229.50 on the upswing. The hourly doesn't really tell us too much. Let's reset this so those anchored view apps are out of there. And we'll just bring it back down to the hourly. It doesn't really tell us much. I mean, maybe thin structure retracement is interesting to the top of the range. So something that's here and then Brigade bolt like this. There's a trade maybe that unfolds for about 2 points. That's a possibility, but once again, in this range, be my guest. This is where things start to open up, in my opinion, more clearly. Microsoft is looking like a laggard these days, and the reason I say that is because there's no hold whatsoever of the previous pivot high over here. And remembering that not too long ago, Microsoft was up towards the top dog in the S&P 500, what does that mean for the chart, right? This breakdown certainly offers a lower high underneath. This is a bit of a daily trend reversal. I mean, you might make the argument that you have a trend line here, but the fact that you're underneath this area, the best pullback would have already looked like this, and then threatening a move higher. That, of course, would be bullish for the S&P. It's just not even close. So what's the fuel to the fire? What's the fuel to the fire in the S&P 500? It's not Microsoft. It might be Apple, but it's definitely not Microsoft. Looking weak here, I would say that any lower highs really fly underneath 425.25. Something that looks like this, very doable, looking for continued downside. Hourly chart to get a little bit more granular. You're already seeing a failure underneath the previous day's low and consolidation below that low. So no reason to be overly aggressive on the long side. I would tend to think, if anything, this is a counter trend move. You're looking for a lower high opportunity here on the hourly, setting up shorts for risk reward right like this, back in the downward direction. So Microsoft leaning more so on the short side. NVIDIA looks... I mean, the higher time frame pattern, if we just go out to a daily here, is that this is left, this is head, and maybe you're building out a right inside of this range. I've cleaned up the chart a little bit. This used to be an orange zone, if you recall, just because on the daily, it's this monster sort of like weekly inflection point here, 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 right? All of these different interactions off of this 118, 115 zone. So if we get underneath that, huge overhead supply, and as we talked about I can't remember what chart it exactly was, but what goes straight down, goes straight up, can likely come straight back down. So the threat here on NVIDIA is under 115.75 into 109.50. I'll maintain that as long as we're just chopping around in this zone. If it is going to be more bullish, I'd like to see some acceptance over the top end of the prior range at 120.50. It was looking like we may have had that gift on Tuesday morning's open. That gift was failed from the buyers with the week close on Tuesday afternoon. Next up, we've got Google. What's going on over here? This actually has relative strength for the catch-up trade, if you will. So inverted head and shoulders never really offered a right shoulder, but we are getting a breakout and acceptance over this range. Just notice the relative strength here. If this is the balance range that the S&P has been dealing with, the S&P is like here in the midpoint, right? It just tested the low. Google is staying over the previous highs. So I like that out of Google. It's continued to look like a relative strength watch here. As long as it's over 174.75, bullish consolidation, looking for upside over time. I will be bearish on this when and if there's acceptance back in this range and a break underneath 161.50 for the concept of thin structure retracement into 156.50. Next up, we have Amazon. What's going on with Nancy over here? I was a little bit more bullish on this one too today, but the daily close does not strike me as giving like a warm and fuzzy feeling inside. The reason being is just this pullback, right, was originally staying over the previous pivot high, which Microsoft was not, just on a relative basis, right, using some comparison here. And then on Tuesday, we looked underneath Monday's low, closed inside of Monday's range. And then today, it's just sort of a lackluster inverted hammer. Intraday, I really would have preferred if this consolidation got up and over the 186.25 for a Brigade Bolt trade that would have looked like this. It's on the table for tomorrow as long as we're in this range, possibly threatening that. But any sort of move underneath 184.25 probably takes that off the table quite promptly. And I'd look more so for that full retracement into 181.50. Next up, the metaverse, one of the strongest names out there in the market as well. Bullish consolidation, failing the all-time high breakout. I'd be my guest if you want to short the strongest name in the market right now. Technically speaking, it is a look above and fail if you're looking at this through the lens of this right here. And technically the target could be 561. You could try a scalp on the short side from A to B. I would really reserve shorts for saying like consolidation in here is still technically bullish. Over time, we'll look for upside. Shorts probably look like this. From 556.25 to the previous all-time high 542.50. Then on the daily chart, like please acknowledge that when that trade completes, that's a trade, we are absolutely looking for an all-time high retest for a Brigade Bolt, something that does this, right? There you go. Daily/weekly high or low, 542.50. Next up, Tesla, skipping around in here. Tesla, before the delivery numbers, was looking great. And the reason I say that is because we had an engulfer, at the low at least, of the Tuesday session that then closed back inside of the Monday range. So you took out 1, 2, 3, 4, 5 days lows, yet closed inside of the prior day's range. So okay, that's probably more of a bullish retracement off the low. Great little hold there of 250. On today's session, nothing. I mean, daily hammer, sure. I still want to be cognizant of the fact that we have broken out over an inverted head and shoulders neckline here, of course. So the pattern is still bullish. And I would just tend to think that this is now a little bit more of a grinder of a trade instead of a snappy, volatile move like Tesla usually produces over 250. So it's still the watch, looking for that upside. This can possibly act as a daily higher low over the neckline breakout. If it does just consolidate, maybe losing a little bit of interest, a firmer retest of 234.15 is absolutely something I'm interested in for this back over time. Here it is on the hourly, just to get a better sense of what happened here. So straight down, straight up, and bullish consolidation into the afternoon probably leaves us with an opportunity to say this is, the long trade is there. The long trade is there for something that does this. That's ultimately the range you're trying to exploit. We'll see if it unfolds, but just noting the amount of range that we have to chop back through, I would just manage expectations and say it's probably not going to be one of those quick, poppy, snappy moves like what we had here. More of a grind out of Tesla, something that looks like this perhaps, right? Next up, JP Morgan. What's going on with the banking demon himself, quite literally. What do we see? We've got highs, lower highs. This consolidation looks weak to me. It's underneath a ton of overhead supply. I would be thinking about equal low breakdowns into this daily equal low. So under 205.50 trades to 201.65. Inside bars relative to the green bar. And anybody who bought that gap down low is probably in a world of hurt as soon as we take it out. So looking for the short there out of JP Morgan, multi-day low flush point underneath Brigade Bolt, looking for this. Once again, that's 205.50 to 201.65. Next up, Netflix. It's hanging in there. It's throwing a lot of mixed signals here. Let's go to the daily chart first, actually. So mixed signal number one, bull flag breakout, retest, possible higher low. Mixed signal number 2 is hourly head and shoulders. After the breakdown on Tuesday, it was like, okay, any sort of flush under 703.50 gets dangerous. Well, now that we've closed back sort of up here, we're testing these highs, really just treating this as an hourly balance. Balance rules here, balance rules here. It's really that simple out of Netflix. Probably not doing anything in between, just wanting to avoid the chop and lackluster ability in there. AMD, it's time to rock and roll. It's time to get on the horse and go. If we look at AMD on the daily, it's got a great retest of its neckline from back here of what is a double bottom. Ideally, this would have reversed earlier in the session and held. If you take a look at the hourly chart, we did get the break up and over. Very nuanced level right here for a bit of that Stevie Wonder trade early in the morning, but the lower high rejection underneath this prior low, whoa, it's not the zoom we wanted. The lower high rejection here is a little bit concerning. And we just saw it as a daily inverted hammer, right? The daily structure basically looks like this. So not the greatest close. If it's in this range, I'll be willing to give it the benefit of the doubt. And maybe it turns into like an hourly double bottom for a trend reversal like this. Longs over 162.65, trade into the bottom of the gap, 169.75. Like those ideas are worth entertaining. But if, with a lack of confidence, because the daily close is so weak, if we start to drift to the downside, really off the radar, and unfortunately what looked like it had strong potential as a daily setup here just goes on the back burner as, okay, what's the next setup? How can we sort of, how can we trade? How can we execute an AMD? Noting that has sort of failed. So that's the watch here. All right, 3 trade ideas for you. I promised something about Bitcoin, so let's go to Coinbase itself. If I could spell COIN instead of whatever I just typed in. This is a bearish trade, so Bitcoin maxi or not, doesn't look good. You've got yourself an inside inverted hammer after an aggressive expansion of range to the downside that stuck. It's trading at this flush point, and I think that you could easily see a move over the span of a day into that 150.75. So about 10 points worth of range. It's a very volatile, very, very volatile stock. Let's take a look in terms of the ranges that it trades intraday, right? Look at this thing, just huge reversal from this failed break back underneath here. Lower high has been set on this hourly trend reversal, equal lows. If you break it, I think you just get continuation of this momentum into these lows closer to 150.75 as we had just mentioned. So it's really the daily inverted, hammer here as a bearish 3-bar play that's getting me interested in the possible downside. The daily trend is down, highs, lower highs, lower highs, lows, lower lows, equal-ish low possibly looking for as an outcome here to the downside. So that's Coinbase. Next up is going to be on PANW for Palo Alto, of course, and the idea here is also similar with a bearish 3-bar play, equal lows. But what I like even more about Palo Alto is just the thin structure retracement. We can all see this on the daily, right? You had a breakout of a flat top on earnings. You came back down underneath, offered a lower high. Now you're trading at the equal low. So of course, the next move, logically, if it's going to make a trend continuation play to the downside, is underneath the low produces lower lows. Under 328.50 trades into 316. Here it is on the hourly. Get ready. Look at this. What goes straight up can come straight down. Really watching out for that thin structure retracement. Again, breaking this. Now you have tons of overhead supply. Really looking for that downside beneath 328.50. Brigade bolt lower highs. Good to go. That's Palo Alto. Last but not least, a little bit cheaper here. Pinterest. Pins needs the S. There we go. Pinterest has a long-sided trade. So we talked about a couple shorts. Let's talk about a long here at a cheaper price point. Look at what's going on. Double bottom neckline breakout. For the love of thin structure, take a look at what's off to the left. Really thin on the sort of earnings gap down unraveling. And I like the little hold here. So you gapped up on Tuesday, you held this zone. And even on today's session, yes, it's an inside bar. And yes, it's underneath the midpoint. But it did close a little bit more firmly versus some of the other bars that we were just looking at. So sustained holds over 32.75 at least target the opening print of Tuesday, if not further continuation towards 35. Probably worth entertaining with common shares if this is something that you want to use as a swing trade back to the daily to sort of get up towards that 200 SMA as a target. I wouldn't really constrain yourself to timing with options. So that's a possible consideration here. If you are going to use options, just understand that they're cheap and you're probably going to have to leverage quite a few of them. What's the spread on this thing? Yeah, very spready, and you don't want to take up too much of the liquidity here. Otherwise, you become an easy target. So just be mindful of that. The spread here on these things, not all that friendly on the call side. Let's see if we go out to the monthly. Monthly volume's not that great. Decent open interest on the 33 strike. That's not that bad of a spread. The volume that transacted today, though, is still pretty paltry, pretty anemic, if you will, to throw in some good vocab words to end out today's episode of the Midweek Market Update. If you enjoyed the episode or learned anything new today, let me know down below in the comments section or by giving the video a very simple thumbs up. We will be live up in the penthouse for the pre-market prep on tomorrow's session for the initial and continuing jobless claims, as well as on Friday. For the full Monty labor report, we're looking at hourly earnings, the non-farm payroll, the official, not ADP, the official, as well as the official unemployment rate on the month-over-month read. We will have coffee and donuts. If you want Turkish coffee, bring your own, bring enough for everybody. Anything other than donuts as well, you know the deal. So we'll see you there. Hope to see you in the pre-market preps. With that said, have a green trading week, and I will see you in the next one.